Well, the table is set and we are approaching 4,100, and that is exactly where I said we would tap out in this market. This is exactly where the bulls and bears thesis are going to come to fruition as the Feds are set to raise interest rates by 25 basis points. In this video, we are going to talk about earnings, the yield curve, and go off the charts in the overall outlook of the markets. What the heck is going on here? As economic data is starting to pour through here, it looks like inflation is getting under control. Sentiment is starting to tick up, but we noticed that consumer spending definitely slowed towards the end of 2022, which makes me believe that this is just a delayed Santa Claus rally. And if you've been on this ride, I did say 4,100 is where we're tapping out. Now, I definitely could get some cake on my face on this one, and I could be completely wrong. But let's think about this really quick. To say that earnings has kicked off, well, fairly confusing is an understatement. Companies like Microsoft, Tesla, and Intel have reported, and I could definitely poke holes in all of them. Now, the one I'm concerned with is definitely going to be Microsoft. This is one that trades at a premium, and growth has slowed drastically. And we'll eventually figure out a price target for Microsoft with the earnings released here, but that'll be in the next video. With Microsoft's earnings, it seems like these problems are going to persist throughout the full year. So why is the market rallying? The market is rallying on a few different things here. It's definitely not earnings, ladies and gentlemen, because if it was on earnings, Intel would be down a lot more, Microsoft would be at a 52-week low, and I don't think Tesla should be rallying as hard as it's rallying. So what's going on? Well, crude oil is dipping once again, the dollar is weakening, and yields are coming down, signaling that the Feds are going to pivot. But what I've been recently looking at here is that the yield curve is not what we should be going off of. It's actually becoming unreliable. The volatility in yields are not allowing us to really depict what is going on in the financial system. So what should we be looking at here? I tend to think that the 2-year yield should be ignored at this point in time, and the Fed fund rate is what we should be looking at by short-term erratic trading and the Fomo trade. When we look at what's really been rallying as far as stocks go, it's the stocks that have sold off 50, 60, and 70%. When we look at companies like Microsoft and Apple, they haven't rebounded quite as hard as something like a Tesla, a Netflix, or even a Facebook. It tells me that the oversold positions, basically the positions that people have been short, are now going long, and it's causing FOMO in the market as smart money has already been in this rebound and dumb money is just getting into the party now, which is causing us to break above that 4,100 mark that I've mentioned numerous times. Now, we'll get to the charts in a minute, but let's stay focused on yields here. Why am I going to use the Fed fund rate instead of the 2-year Treasury? The Fed fund rate is actually where yields are specifically going, while the 2-year Treasury is the market trying to figure out what the Feds are going to do. And I'd rather just take the Fed's word at this point in time. And if that was the case, then the yield inversion just took place, as the Fed fund rate is now at 4.1 and the 10-year Treasury is sitting at 3.526. I'm no longer paying attention to the 2-year Treasury as much, as I do think it's being manipulated and there's a lot of volatility in the yield market, and I need something with a little bit more stability and truly where rates are going. And we all know that the Feds are going to keep hiking here, which is going to steepen the Fed's fund rate versus the 10-year Treasury, and that's what I'm going to stay focused on going forward. When we factor in that earnings are retracting, but the stock prices are skyrocketing, this is usually a recipe for disaster if you're trying to get into this trade now. You've already missed the majority of the move, and for me, I tend to believe that the next leg is still coming down. And a great example of this is going to be Intel, ladies and gentlemen, as earnings are truly going to be what matters in the end. Yes, these short-term moves are impressive and markets are very volatile right now. But when we really look at what's going on, it's crypto and it's the high beta plays that are really taking off here. And it's causing FOMO in the market and it's causing people to overspend. While earnings are not as bad as everybody anticipated, there is still some questions I have. The market is currently trading at a 22 PE ratio, which we all know is historically high, and earnings are still coming down, which makes this even richer. When we compare that to a company like Microsoft trading above market premium at a 27 PE ratio, but we know the earnings contracted to 2016 levels, this is a very rich premium as Microsoft stock is starting to go up. but the earnings are contracting. Very dangerous game to play here. If we keep going on this path, this is what we can expect. An intraday move of -7 to 10%, because what ends up happening is when there's no catalyst on the table of positive news, we have to go back to fundamentals. So when the conversation is not about the feds and when the conversation is not about inflation getting under control, but it's actually truly about the fundamentals of individual stocks, well, this is what happens, guys. We get a huge retracement back down. And trust me, this can happen with Apple. This can happen with Microsoft. We've already seen it with Netflix. We've already seen it with Meta. So pay attention to the fundamentals here, guys. Don't just look at the short-term data. When we think longer term, we want to buy good companies at reasonable prices. Right now is not a reasonable price. Earnings are contracting and stock prices are going up. Now, of course, this is just my opinion. When we look at a 1-year chart on the S&P 500, we are absolutely breaking out here, and we are pretty darn close to getting cake on my face. What do I mean by that? Well, in order for my thesis to really stay intact, even after this breakout, we really need the S&P 500 to stay below. We really need the SPY to stay below 410. We still have lower highs and lower lows in this market. So in order for this to stay intact, I basically need this to start coming down, which lines up well with the Fed's meeting next week. So as long as the SPY stays below 410, I tend to believe there is still an opportunity here, and this could be an absolute bull trap. But when I look at the fundamentals, I still believe a lot of stocks are expensive, especially when we factor in that earnings are contracting. Now, not all earnings are contracting. As we all know, the credit cards reported, and they reported strong numbers. Well, and as we can see, consumer credit is skyrocketing, so these numbers shouldn't have caught us off guard. Because inflation has been elevated for an extended period of time, and there's been this move from goods to services. People want to travel, they want to go out and live life as they've been locked up for an extended period of time, and they don't care anymore. And so they're swiping cards like maniacs, and therefore, yes, the credit card companies are absolutely in a bull market, but the consumer could be a bull trap. We're getting to a point where I think a lot of people are going to be late to this one. And unfortunately, the feds can pull this rug from retail once again. So yes, the market has rallied and it's been impressive. But if we factor in where earnings are heading, where the consumer is heading, and margins are now compressing for most companies, not all companies, makes this a pretty expensive market. And as crazy as this sounds, when we measure out the risk of this market here as it's still creeping up, I tend to think that there's an argument to be made with where earnings are going and where yields are heading and how margins are compressing and layoffs are just starting, that there's an argument to be made that the 2-year treasury makes a lot more sense than stocks right now. And in my opinion, that is a problem. How much higher can this market go? Maybe it goes back to 4,800, but then that makes it a ridiculously expensive market when I can get a risk-free return of over 4% on a 2-year treasury, and I can make a little bit more sense of that versus earnings coming down and markets going up. Now, as we all know, we looked at recent market crashes, and the one commonality we found, earnings don't always matter. Markets can still go up, and we can miss those runs. But what does matter is going to be GDP. The consumer starting to slow towards the end of 2022, and 70% of our economy based on consumption. GDP will be slowing down, and there's still going to be a tremendous buying opportunity. When will that buying opportunity come? Well, the consumer is definitely more resilient than I anticipated, and so is the job market. But I still believe it's coming this year. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.